Here's something nobody wants to hear, but everybody over 60 needs to understand. That comfortable retirement plan you've been banking on, the one where you just ride out whatever storm is coming and wait for markets to bounce back like they always have, it's quietly becoming the most dangerous financial strategy you could possibly choose. I'm not talking about some dramatic market collapse that makes headlines. I'm not talking about black swan events or financial apocalypse scenarios. I'm talking about the slow motion disaster that's already unfolding in millions of retirement portfolios right now, while everything still looks manageable on the surface. Because here's what the financial industry doesn't want you to know. The moment you cross 60, the old rules stop working. The strategies that built your wealth start destroying it. And the biggest mistake isn't what you do during a crisis. It's what you don't do before one arrives. Right now, 73 million baby boomers are standing at the exact same cliff edge at the exact same time. More than 60% are already retired or within 5 years of retirement. That means tens of millions of people are about to discover that markets can wait, but they cannot. And that difference becomes fatal right before the system snaps. You've heard it your entire investing life. Markets always come back. Stay the course. Time in the market beats timing the market. Don't panic. Be patient. And for decades, that advice was absolutely correct. Every major decline was eventually followed by recovery. Every crisis became an opportunity. The chart always trended upward if you zoomed out far enough. But here's what that chart doesn't show you. It doesn't show withdrawals. It doesn't show inflation eating away at purchasing power. It doesn't show medical bills that can't wait for the next bull market. Most importantly, it doesn't show what happens when you're no longer adding money to your account every month, but taking it out. The market chart never retires. You do, and that changes everything. Let me show you exactly how this trap works, because once you see the numbers, you'll understand why waiting feels safe, right up until the moment it destroys your financial future. Take someone who retires with $500,000. That's not extravagant. That's a common target that financial advisors recommend. To fund basic living expenses, most retirees need to withdraw 4 to 6% annually. Let's use 5%. That's $25,000 coming out every single year, regardless of what markets are doing. Now imagine the market drops 30% early in retirement. Not a crash, not a black swan, just a normal correction that happens regularly throughout market history. The $500,000 portfolio suddenly becomes $350,000. But life doesn't pause. Expenses don't stop. The $25,000 withdrawal continues. Here's where the math gets ugly. Those shares you're forced to sell at depressed prices, they're gone forever. When markets eventually recover, they're recovering on a permanently smaller base. The lost capital doesn't magically reappear when the market hits new highs. You've locked in a structural reduction to your portfolio that can never be undone. This isn't theory. This is arithmetic. And it is happening to millions of people right now who think they are being conservative by doing nothing. The median net worth of a baby boomer household is roughly $250,000 to $300,000. The average is much higher, over $1 million, but that's skewed by the wealthy few. Most people are living closer to that median number, and they feel the squeeze every month. When you look specifically at retirement accounts, the picture gets even tighter. The average 401k balance for someone between 60 and 65 is around $200,000 to $230,000. The median is significantly lower. That means a relatively ordinary market decline combined with regular withdrawals can permanently devastate the retirement prospects for a massive portion of older Americans. And this isn't just an individual problem. Total U.S. retirement assets exceed $40 trillion. Defined benefit pension plans account for more than $11 trillion. Public pension systems are underfunded by an estimated $1.5 to $2 trillion. The system itself is dependent on returns at the exact same time. Millions of retirees are dependent on withdrawals. This creates structural pressure that builds long before any official crisis appears. When stress eventually hits markets, selling becomes mechanical, not optional. Withdrawals happen on schedule regardless of market conditions. When millions of people are forced to sell at the same time, the idea that everyone can simply wait for recovery becomes mathematically impossible. Markets don't recover in a vacuum. They recover based on money flowing in. But retirees are no longer providing inflows. They've become outflows, permanent, predictable, unavoidable outflows. Now let me show you how this damage compounds, even without a dramatic crash, because this is where most people's understanding completely breaks down. After the market peak in 2000, it took roughly 7 years for the S&P 500 to recover in nominal terms. After 2008, about 4 to 5 years. In the 1970s, markets recovered on paper, but inflation quietly destroyed real purchasing power for more than a decade. Even when prices came back, lifestyles didn't. Let's be conservative and call a major recovery cycle 5 to 10 years. That's not extreme. That's history. Now layer that onto retirement reality. The average retirement age is around 63. At that point, most people have little to no earned income. They're no longer contributing monthly. They're no longer buying dips. They're funding living expenses from existing capital. This is where waiting stops working. Before retirement, market declines are temporary inconveniences. After retirement, they become path-dependent events. The sequence of returns matters more than the average return. Losses early in retirement do permanent damage that good returns later cannot repair. Let me put real numbers on this to show you exactly how the illusion crumbles. Go back to that retiree with $500,000 withdrawing $25,000 annually. When the market drops 25%, the portfolio falls to $375,000. That withdrawal rate just jumped from 5% to almost 7% on the smaller base. Even if markets deliver solid returns afterward, the mathematics have permanently shifted. The account is structurally smaller, the compounding engine is weaker, the margin for error has vanished. And here's the part that destroys most retirement plans. Inflation does not wait for your portfolio to recover. If inflation averages 4%, which is not extreme by historical standards, the purchasing power of money gets cut almost in half over 18 years. When someone says they'll wait for markets to come back, the question becomes, come back to what? Nominal prices or real purchasing power? Before moving forward, if this video made you stop and think, then the conversation doesn't end here. Leave a comment below and tell me what topic you want us to go deeper into next. This channel exists to break down what most people are never told, and your questions shape what comes next. If you want to understand these shifts before they become obvious to everyone else, make sure you subscribe, like this video, and turn on notifications. Because what's coming won't be explained on the evening news, but it will be explained here. A flat market combined with 4% inflation isn't stability. It's a guaranteed real loss. And retirees feel this faster than anyone because their expenses don't shrink when prices rise. Healthcare doesn't get cheaper. Insurance doesn't get cheaper. Food doesn't get cheaper. Property taxes don't politely wait for your portfolio to recover. This sequence of events matters more than any average return. Two portfolios can have identical long-term performance and produce completely different outcomes depending on when losses occur. Losses early in retirement are far more damaging than losses later, even if markets eventually recover. This has been demonstrated repeatedly in retirement modeling for decades, but most people still plan as if averages are all that matter. Now zoom out to see how individual mathematics become system-wide catastrophe. Tens of millions of retirees are drawing from portfolios simultaneously. Pension systems must meet obligations on schedule. Social Security is paying a historically large retired population. All of this is happening while demographic support weakens. There are fewer workers relative to retirees than at any point in modern American history. Fewer inflows supporting larger outflows. This isn't political opinion, it's demographic reality. It's the same mathematics that breaks pension systems worldwide, regardless of local politics. When markets face stress under these conditions, selling becomes forced rather than voluntary. Withdrawals don't pause because valuations look unattractive. Pension obligations don't disappear because returns disappoint. When selling becomes mechanical, prices don't wait for optimism to return. This is why the phrase markets always come back becomes misleading after 60. Markets may recover eventually, but the path determines outcomes more than the destination for people who need income now. Look at what happened during the lost decade from 2000 to 2010. The S&P 500 went essentially nowhere for 10 years in nominal terms. In real terms, it lost purchasing power. People accumulating during that period survived because they added capital and bought at lower prices. Retirees near the peak didn't have that luxury. Many depleted significant portions of their portfolios before any recovery began. Japan tells an even starker story. The Nikkei peaked in 1989. Decades later, it still hasn't recovered in real terms. Retirees who waited it out didn't get a second chance. They experienced slow erosion of purchasing power that never reversed. Entire retirement plans built on the assumption that markets always come back simply didn't work. In the 1970s, United States, markets technically recovered and nominal prices eventually moved higher, but inflation destroyed purchasing power year after year. People thought they were breaking even while their real ability to pay for necessities collapsed. Retirees felt this fastest because their income was fixed, while costs weren't. The pattern repeats consistently. Market outcomes vary, but human outcomes follow predictable paths. When losses or stagnation intersect with withdrawals and inflation, retirees lose options, not overnight, gradually, quietly, permanently. A permanent loss of 20 or 30% after 60 is not an inconvenience or a smaller vacation budget. It changes decisions that cascade through the rest of life. It determines when retirement happens. It determines housing choices. It determines medical flexibility. It determines whether independence gets preserved or slowly traded away. Forced downsizing isn't a lifestyle choice when it happens under pressure. Delaying retirement isn't empowering when driven by necessity rather than preference. Depending on children or government programs isn't planning when it arrives unexpectedly. These aren't dramatic outcomes, they're common outcomes that happen when optionality disappears. This is why so many people over 60 feel uneasy right now, even though nothing has officially broken yet. They sense the old assumptions no longer fit the current environment. They see pressure building. They see costs rising faster than assets. They see systems under strain. They just don't have a framework to articulate what's wrong. The real risk isn't that everyone will be wiped out. The real risk is that millions of people will enter the next period of market stress with assumptions that no longer hold. They'll believe they're being conservative by doing nothing. They'll believe patience carries no cost. They'll believe waiting is neutral. But waiting is a position, and after 60, it's often the riskiest one available. This reframing matters most of all. Real risk isn't volatility. Volatility has always existed. Real risk is passivity under a broken model. It's assuming time will do the work when time no longer works in your favor. It's assuming recovery timelines are irrelevant to personal timelines. Being conservative doesn't mean ignoring risk. It means understanding where risk actually lives. After 60, risk lives in drawdowns combined with withdrawals, inflation combined with stagnation, delayed recognition combined with irreversible decisions. Nothing I've described requires a dramatic collapse. This mathematics works against retirees even in mediocre environments. A long period of low real returns does the same damage as a sharp crash. That's what makes this dangerous. It doesn't announce itself loudly. It unfolds quietly while people wait for confirmation that never arrives. The mistake is almost never panic selling during a crash. The mistake is entering stress periods with wrong assumptions already baked into plans. The mistake is believing that doing nothing equals safety. The mistake is confusing familiarity with security. Once you see this clearly, the question changes completely. It's no longer will markets recover. Markets always do something eventually. The real question becomes, can I afford the path it takes to get there? For many people over 60, that question has an uncomfortable answer. This isn't about fear. It's about awareness. It's about replacing comforting narratives with accurate ones. It's about understanding that the environment you're entering is not the one you spent most of your working life navigating. Strategies that worked under one set of conditions don't automatically transfer to another. The goal isn't predicting the future. The goal is avoiding preventable regret. The goal is recognizing when a passive stance quietly becomes an active risk. The goal is preserving optionality before it disappears, not after. People who get hurt most are never the ones who didn't know something was wrong. They're the ones who knew, felt it, sensed it, but waited for certainty anyway. And certainty always arrives too late to matter. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.